Hello, everybody. My name is Nicole Elliott, and I'm a technical analyst and private investor. And for today, my delight is going to be to talk about terrible triangles which cause trauma, because they're really doing my head in. And so we'll go to my first chart, which is a weekly one of the yield on the US 30-year Treasury bond. This is the one on which US mortgages are based, okay? And as you can see, since March, we've been in some sort of a triangle, which also happens to lie just underneath a trend line from early 2019, and well below the previous record low set in 2019 at a smidgen under 2%. And you can see for the whole of this year, we've held well below that. In other words, we're stepping down again. So we had a horrid triangle in the second half of 2019. Now we've got an even bigger one going on and on and on, and we're not getting very far. And quite frankly, a bit of fiddling by the Fed, as they did yesterday, isn't going to change this. And it isn't going to change this secular trend that started in 1981. So the lower the yields go, the more it costs for investors to buy a US Treasury bond. That's the way it goes. And I don't know when we're going to break out, but I'm fairly convinced we're going to go lower in terms of the yields. So back down towards, say, 1%, something like that. We're currently at just under 1.5%. Now, my second chart has also got another terrible triangle. This is the price, a daily chart of the price of spot gold, not futures, spot gold, starting at the March 2020 low. And you can see it's been in an uptrend, but since the summer, it's been in another triangle, symmetrical triangle again, which has allowed the 50-day moving average and the 100-day moving average to move up towards the current spot price at $1,944 US per ounce. And as you can see, because we went so far into the apex of the triangle, it's no longer valid. We've broken out. We've broken out on the upside. It didn't really work. I don't know what. Classic Dow theory suggests that if consolidation in a symmetrical triangle continues beyond 2/3 of the move towards the apex, chuck the pattern, just chuck it, get rid of it. You're not going anywhere. You could draw and redraw. You can see how you could redraw the line for the upper side of the triangle, the upper edge of the triangle. But I mean, what's the point? What is the point? This thing isn't going anywhere, and it's totally lacking in any sort of momentum at all. So it's not one to really bother with charting wise. I mean, you may want to hold it for other reasons, but certainly the chart doesn't suggest anything very much is going to happen soon. And my third and final chart is a slightly different one. It's a weekly candlestick chart, again, with the Ichimoku clouds on it. And again, I've got two long-term trend lines, one from 2016, one from 2015, which sort of capture the upper edge. In other words, the rallies that we've got have been capped by those two lines. Now, the more interesting line is the one at the bottom, that captures most of this huge move since the beginning of 2019, end of 2018, actually. The bottom one, which is a horizontal at 105 yen per US dollar. We did have a huge slump below it in the sort of beginning of the sort of pandemic and all that. And now what we've had this week is a sort of slightly more aggressive downside candle. That's the last red one on the right. And you can see that you start at the top and you're currently at the bottom. And the bottom lies just below 105 yen. Now I've got to get through today and tomorrow and to see where it closed. But this is a really worrying start to the Bank of Japan, who met today, and for the new Prime Minister, Mr. Suga, in the face of extremely weak economic data recently coming out of Japan. Very worrying for them politically. That's all I've got for today.